At the Private Equity Observatory at HEC Paris, I've recently conducted a study that addresses now the challenge of how to better understand the drivers of return at a limited partners portfolio. Lots of private equity benchmarking and measuring is happening at the fund managers level, and limited partners then build, of course, portfolios of varying funds which are very different in nature. They may differ in the vintage years to which they commit and the geographic exposure, and at the end of the day, investors just see at the aggregate what was the overall performance of that portfolio, which may not always be very informative in the how of value creation. So I'd like to propose a simple technique on how to get a little bit more insights into the why and the how of value creation. And that starts basically with a benchmarking of every single set of funds in that portfolio against universes of other funds. Now, conceptually, you can say you picked certain funds and you could have picked them from all possible private equity funds out there. But naturally, private equity fund limited partners investors are not free in their choice, but they're subject to certain strategies. There are certain strategies with respect to when historically they could invest in private equity, how they allocated capital to different vintages. And so not all private equity funds were in their option set, so to say, but there was a reduced set of private equity funds matching the timing of that particular limited partner. You can further restrict the opportunity set if you consider the strategic imperatives. Maybe the limited partner was not allowed or hasn't chosen to invest in more nascent areas of private equity. Maybe Asian venture capital was out of scope, or there was a rule not to invest in the European small cap segment. So the fund stage and the geography may be different criteria based on which we want to filter the reference set. Ultimately, this leaves us then, for every limited partner, with a comparison between those funds they've chosen and those funds they could have chosen from. And if you translate each of those bubbles of private equity funds on this diagram, and you compare the performance of those, you can basically translate this into a bridge chart. A bridge chart that tells you the sources of value of a private equity limited partners portfolio from the very right-hand side, the actual portfolio of that limited partner. Starting from the very left, simulated investments in all private equity funds on a pro rata basis. This technique allows us to break down and identify the performance impact of each of those different decisions. The decisions about the timing, the decisions about the geographic choice, the decisions about the strategic choice, and then ultimately, probably most importantly, the ability of a limited partner to identify those fund managers within a given strategy, within a given opportunity set that were ultimately outperforming. Now, you can draw these pictures for every single limited partner. It's relatively simple to do this mathematically if you have the right benchmark data. And it's quite illustrative because it also features the performance impact of decisions that may be taken at different parts of the organization. Strategy, overall timing and allocation over time, and then ultimately manager selection. We've performed the analysis of this type for several dozen of US public pension schemes who conveniently for us put data about their private equity portfolio in the public domain. And we saw an interesting pattern. We saw that the timing impact for the vast majority of those has been negative. So apparently the majority of those over-allocate capital to those vintage years in private equity that underperform the average. Now, if you plot this on the following chart here, everything that is gray is basically the performance impact, the negative performance impact of those who get the vintage timing wrong. And there are a few on the right-hand side in green who are gaining returns based on the vintage year choice. This is surprising, and we looked for possible explanations behind this. And one possible explanation comes from the comparison between the vintage year performance over time and the business cycle. On the following chart, you see a curve that gives you the average vintage year performance of all the private equity funds starting in a given calendar year, and then compare this to the economic performance captured by the S&P 500 index of that particular calendar year. That's not comparing apples to apples from a timing perspective, but that basically tells you how the performance of private equity funds starting in a given year is tied to the economic conditions in that given year. Why is this relevant? Well, many private equity investors, in particular the US pension schemes, explicitly or implicitly have a fixed percentage allocation to private equity. The rule can be, for instance, to allocate or to seek a capital exposure of 5% of the total assets to private equity at given point in time. What does this mean? In years where the overall economy is expanding, the stock markets are up, the overall pie, asset under management, is growing, forcing private equity limited partners to try and put lots of money into private equity. If they're underallocated, they commit lots of capital at this point in time to the asset class, and that tends to be structurally just the year where historically they haven't found the greatest returns. On the contrary, those years characterized by economic contraction, stock market down, the pie is shrinking, puts many limited partners in the situation that they find themselves over-allocated to private equity. They pull back, they do not commit in those years, they may even sell fund stakes in the secondary market, and that structurally makes them lose out and miss on those vintage years which historically have been the highest performing. So this so-called denominator effect may explain part of this picture where the majority of limited partners who are likely to be subject to this rule may suffer from the performance. If you question, why do we care? Is this a problem? Well, you should probably care, in particular if you care about the health of US public pensions, because if you do the math on this, the average private equity limited partner US pension fund is losing 5 cents on the dollar on each dollar put in private equity. Collectively, they have about 320 billion US dollars exposure to the asset class. So this little 5 cents turns into 16 billion of lost gain, simply because for structural reasons apparently the vintage allocation is imperfect. How do we improve upon this? Well, it may be time to rethink this fixed allocation rule, giving the investment teams maybe a band of a breathing band, allowing them to allocate more regularly over different vintage years, irrespective of the fluctuation of the market that may influence the shrinking or the growing of the overall pie.